A very good morning, friends. I hope you're all doing well, and I hope your revision for the November exam is also pretty going well. So the last phase of our consolidation standards, we've spent a good time covering these standards on Ind AS 103, then followed by Ind AS 110, Ind AS 111. And we've got the last trail of the standard, that is Ind AS 28, and a bit on Ind AS 27 as well. Though I think the main focus, of course, is going to be on Ind AS 28. Well, Ind AS 28 deals with the concept of accounting for investment in associate and joint venture. Yes, you heard it correct, that we're looking at Ind AS 28, that it looks at accounting for two kinds of investment. One is investment in an associate and one is investment in a joint venture. Well, if you recall, when we did the concept of Ind AS 111, I pinpointed the moment you decide that a joint arrangement is supposed to be a joint venture, the accounting shifts to Ind AS 28. But when you're covered under a joint operation, that means a joint arrangement turns out to be a joint operation. In that case, the accounting is covered under Ind AS 111 itself. So let me first of all give you some few focus that when does Ind AS 28 get triggered, because we know that in terms of associate as well as in terms of a joint venture, the standard would trigger. But I just like to give you a little more clarity of thoughts that what are the various permutation combinations under which Ind AS 28 would trigger. And of course, let me also tell you, I might have said that earlier as well, that when you're looking at accounting for investment in an associate or a JV, the method of accounting is called equity method. And we're going to see in detail today, how does an equity method apply? But before that, I think let's have a look at some permutation combinations, that which cases is Ind AS 28 going to trigger. So let's have a look at the initial input. So we're working on Ind AS 28. So I think let's first take a plain vanilla case where Ind AS 28 would apply. So let's consider a simple case where let's say there is a company A, and this company has got, let's say, a significant influence over B. Now, when I say significant influence, Ind AS 28 tells me, that generally, mind the words carefully, generally, if you've got 20% or more voting power in a company, there is a presence of significant influence and vice versa. That means if you've got below 20% voting power, there is no significant influence, but there can be exceptions. There could be other facts and circumstances which might indicate that even if you've got more than 20% voting power, there may not be a significant influence. And there could also be a possibility you've got less than 20%, but still there is a significant influence. So as a general thumb rule, with exceptions, we can say significant influence arises when you've got 20% or more than 20%. We're including 20% as well, and more than 20% as well. So if A has got a significant influence, then we can say A is supposed to apply Ind AS 28. He would make the separate and consolidated financial statements. So in the consolidated financial statements of A, he would apply Ind AS 28, and in the separate financial statements, he would apply Ind AS 27. Now, let me just tell you quickly at this stage, when A prepares a separate financial statements, he would represent the investment in B using either a cost or a fair value approach. Ind AS 27 gives a choice to the company, then you can either use a cost model or you can use a fair value model to reflect the investment. Now, the moment you choose a fair valuation model, you are back to Ind AS 109. Let me remind you that the financial instrument standard excludes investment in equity instruments of related party. Let me put that again. If you look at the scope of Ind AS 32 as well as Ind AS 109, that is financial instruments, it very clearly excludes out of the scope of the standard investment in related parties, subsidiary, associate, as well as JV. But if you apply Ind AS 27, Ind AS 27 gives you an accounting policy choice that investments in the separate financials can be taken at cost or a fair value. The moment you choose a fair value, you come back to Ind AS 109 and you need to decide FVTPL or FVTOCI as the case might be. That is just to give you an insight in terms of Ind AS 27. Okay, so this is one case which is a plain vanilla case. Let's have a look at another case as well. And let's see a situation where, let's say, there is a company A and it has got over a company B. Let us say a case of, let's say B is supposed to be a joint venture. So now in this particular case, we can say, let's say A plus C. Let us say A plus C, there are two parties who have got a joint control over the company B. So A and C are two parties who've got a joint control over the entity B. And this joint control resulted in a joint arrangement, but this joint arrangement became a JV. So mind it carefully that A and C have got a joint control, not significant influence. They've got a joint control over B, and this resulted in a joint arrangement, but then it got classified as joint venture under Ind AS 111. In this case as well, we can say the same situations would arise. A as well as C in the consolidated financials would apply Ind AS 28, and in terms of separate financial statements would apply Ind AS 27. So as you can see very clearly that in my first example, B is supposed to be an associate. I'm just trying to emphasize the name of the standard. So in this case, we can say B is supposed to be an associate. And in terms of the second example, you can clearly see that B is supposed to be a joint venture. B is supposed to be a joint venture. So Ind AS 28 very clearly says that accounting for investment in associates and accounting for investments in a joint venture, we are going to apply Ind AS 28. So not only a significant influence would result in 28, but also a joint control could result in Ind AS 28, provided it becomes a JV. Let me remind you, if the joint arrangement becomes a JO, then in this case, we can say that in this case, Ind AS 111 would apply. Let me give you another interesting third situation as well, which we covered in Ind AS 111, but I think let me remind you back out here. So I'm just taking you back on another situation. Watch this carefully. So let's say we've got three parties, A, B, C. So let's consider we've got three parties, A, and let's consider C and D, and this is the entity B. Now, watch this carefully. This is an interesting situation indeed. So we are saying A and C have a joint control over B. A and C have got a joint control over B. Remember a situation where I gave you like three parties have got 50, 30, and 20%. So let's remind you that let's say fee A has got 50%, C has got 30, and D has got 20% stake. The decisions are to be taken on the basis of 75% majority. So we saw in this particular case that A and C can achieve that 75% combination, and D is not a party with a joint control. He is a part of the arrangement, but he is not a party to the joint control. So he is a part of the joint arrangement, but he doesn't have a joint control. So we said in this particular case, if he does not have a joint control, you could make an assessment that does he have a significant influence. So there is a party, one of the parties to the arrangement which is not having a joint control. And in this particular case, we need to assess whether he's got a significant influence. Now, if he's got a significant influence, then in this particular case, D is supposed to apply Ind AS 28 in terms of consolidated financials, and in terms of separate financials, Ind AS 27. So you can see something very interesting indeed. Though let me tell you that B might be classified as a joint operation or a joint venture. The joint arrangement which is there might be classified as a joint operation or joint venture. Now, let me make it very clear once again. If there are three parties, A, C, D, and it becomes a joint arrangement, A and C have a joint control. Classified this as a joint operation. If this is a joint operation, A and C are going to apply Ind AS 111 in terms of consolidated financials, and they're going to apply Ind AS 27 in terms of separate financial statements. Rather, I would say not even 27. If it is a joint operation, the accounting treatment is absolutely similar. Sorry, not Ind AS 27, my mistake. So this is again going to be Ind AS 111 itself. Both in the separate and the consolidated financials, E and C would apply Ind AS 111. But if it turns out to be a joint venture, in that particular case, he would apply Ind AS 28 and 27. I think the third situation is a bit tricky. Let me just put the third situation once again to you so that there is no confusion. So we are saying there are three parties, A, C, and D, and let us say it is classified as a joint arrangement, but the joint control is only with two parties, A and C. D is not a party with a joint control, so therefore you make an assessment, maybe it's got a significant influence. So A and C have got a joint control, one, and D is got a significant influence. D in any case would apply Ind AS 28 and 27 for the consolidated and the separate financial statements. But as far as A and C is concerned, depends upon the arrangement is a JO or a JV. If it is a JO, then in this particular case, A and C would apply 111 for both consolidation and separate financials. And if it turns out to be JV, then they would apply Ind AS 28 as well as Ind AS 27. I guess I am pretty clear. So I've given you three possible apparent combinations where Ind AS 28 would trigger. So one is a clear-cut case of a joint of a significant influence. Another is a case of a joint control resulting in a joint venture. And the other is, a few parties have a joint control and another party got a significant influence. The entities with a joint control would make an assessment, it's JO or a JV, and accordingly the standards would apply. And the company with a significant influence undoubtedly would apply Ind AS 28. I hope, friends, I am pretty clear on when does Ind AS 28 gets triggered. Okay, let me still see if there are any questions coming to your mind so far. Otherwise, we take the journey forward. Okay, good morning, Viraj. Good morning, Namrata. Good morning to all of you. Okay, so this is one chain. Now, let me tell you what we are going to cover in this particular standard with you. The first stage, what we will do, we are going to learn how to assess a significant influence, which is not a very difficult exercise. Unlike the assessment of control or a joint control, this is going to be a pretty simple exercise. So the first focus will be the assessment of a significant influence. And of course, it is not rule-based again, it is a principle-based assessment. Number two, we need to understand the accounting under Ind AS 28, which is called an equity method of accounting. Number three, we need to understand certain cases where the concept of equity method is being given certain exemptions or exceptions. Remember the concept when we discussed Ind AS 110, where we said that there are certain exemptions and certain exceptions of consolidation. Exemptions means that the standard gives you a choice not to consolidate. And exceptions means that the standard mandates you that you cannot consolidate. Similar kind of situations are given in Ind AS 28 as well. The cases where we will say, yes, you got a choice. And the cases where we'll say, no, it's mandatory. You cannot consolidate under Ind AS 28. And the fourth area is dealing with the appendix to Ind AS 28, where in an associate company, you may have some long-term interest other than, you can say, equity shares. So we've got total 4 focus areas to be covered. One is with reference to the, first of all, you can say assessment of significant influence. I think, let me just pen them down. So what I'm going to cover with you is a total of 4 areas. So we are going to cover these 4 areas in terms of the standard number one, we're going to look at the assessment. We're going to look at the assessment of significant influence. Number two, we're going to look at the equity method of accounting. That if there is a significant influence, then how does the equity method apply in terms of consolidated financial statements? And number three, the third thing what we're going to look at is number three, we got to see the scope of the standard, that what kind of exemptions and exceptions have been given in the standard. Exemption means it's a choice of not consolidating, and exception means where it is mandatory that you cannot apply Ind AS 28. So this is a case of option where you've got a choice not to apply, and this is a case of mandatory situation where you cannot apply Ind AS 28. And then finally, there is going to be a fourth area where we need to cover the appendix of Ind AS 28. And in this appendix, we're going to cover that if you've got any long-term interest other than ordinary shares. So this is dealing with certain long-term interest, a very interesting area. So these are the four sections what we're going to cover in this particular standard, not necessarily in the same order. I think I'll first start with this part, then maybe I think depending upon my time, I might go to this part and this part. And finally, of course, last we'll go to this part. So this is the total areas what we need to cover in terms of Ind AS 28. So let's begin the journey. I think the introduction part is done. Let's get on to the concept of assessment of a significant influence. Okay. So what I have done, I have taken a little extract of the standard Ind AS 28. And in this particular case, I'm just going to show you what does the standard say on the significant influence assessment. So let's have a look out here on the significant influence assessment. So this is the para number 5. I guess it is pretty much visible indeed. And let's have a look at what para number 5 says on a significant influence assessment. It says in terms of para number 5, if an entity holds directly or indirectly, example through subsidiaries. Now that is very important. There is a very interesting clarification which is given in the education material. Yes, the institute has issued an education material on Ind AS 28 as well. And it very clearly, gives you the position in terms of the para number 5. It very clearly says that if an entity is got directly or indirectly, indirectly has to be only through a subsidiary. I use the word very carefully. Indirectly has to be only through a subsidiary. For example, if I say direct, I can say A is got, let's say, a 25% stake in B. This is direct. And there is another situation where you can say that A is got a control over B, let's say a 60% stake, and B is got a 25% stake in C. So I would say this is a case where A has indirectly through a subsidiary has got a significant influence over B. And in this case, I would say it is direct. So this is a case of direct and this is indirect. If I say indirect, remember, it has to be only through subsidiary. I'm not saying example. I'm saying it is only through a subsidiary. If you've got a percentage in a company through an associate or maybe through a joint venture, it does not qualify for the purposes of Ind AS 28. So your indirect control has to be only through a subsidiary. It says you've got directly or indirectly a 20% or more voting power in the investee. It is presumed that the entity has got a significant influence unless it can be clearly demonstrated that this is not the case. That means on a very apparent level, if you've got 20% or more voting power, it implies a significant influence unless the facts and circumstances indicate otherwise. Conversely, if the entity is got directly, indirectly, it says less than 20% of the voting power, it is presumed that there is no significant influence. So it is presumed in that particular case that there is no significant influence. So it says it is presumed that the entity does not have a significant influence unless such influence can be clearly demonstrated. So one thing is very clear in pattern number 5, they've made one thing very clear, that you need to have a direct and you need to have maybe an indirect, but indirect is only through a subsidiary 20% or more voting power. If you've got less than 20%, it generally implies no significant influence. 20% or more implies a significant influence. But then there is something more, which is given in pattern number 6. It says the existence of significant influence is usually evidenced by one or more of the following ways. So there are a total of another 5 parameters which are given in the standard. And they say that these indicators might say that, you've got 20% plus or 20 or 20% plus, but I feel no, there is no SI. Significant influence. These parameters could indicate that you've got less than 20, but I would say still there is a significant influence. So it can be a subjective assessment. It can be something which is judgmental in nature. Now, what are these items? Very self-explanatory in nature. It says representation on the board of directors. It says participation in the policy-making process, including decisions about dividends or other distributions, material transactions between the entity and the investee, interchange of managerial personnel or provision of essential technical information. The investor and investee may have certain transactions with each other. And the couple of examples given is that there are certain transactions between each other, but those transactions need to be material in nature. There might be interchange of certain managerial personnel. There might be provision of certain essential technical information. So 3 areas which would indicate, the interaction between the investor investee could indicate a significant influence. Material transactions, interchange of managerial personnel, provision of essential technical information. Apart from that, representation on the board of directors, participation in the policy-making process could be certain reasons, could be certain cases which may indicate that there is or there is not a significant influence. Nobody. We will pen down some notes also to you. But I think before I go to the notes, I want to first of all give you the explanation on that pattern number 5, one of the questions which is there in the education material. Let's, I think, first go to that. So I'm going to first of all take you to a simple little question, which is a clarification given in the education material. And let's have a look at the question number 7 on the screen. So this is one of the questions which is given in the education material and clarifies wonderfully well the concept of pattern number 5. So let me, I think, just read what is stated in this particular question, and we'll interpret that through subsidiary indirectly in this case. It says entity X has got 100% investment in a subsidiary A. So X has got a wholly owned subsidiary A, which in turn has got a 20% investment in an associate. So X has got 100% in A has got 20% in Z. In addition, X also holds a 25% investment in an associate B, and it has also got a 50% investment in a joint venture C. So X has got a couple of investments. He's got investment in subsidiary A, associate B, and a joint venture C. And the subsidiary A has got investment in the associate Z, each of which also has got a 10% investment in Z. I think we need a diagram. We need to understand, what various investments are there. So the diagram is also given for your reference. So this diagram is already given. So we can see all the inputs given in terms of the investments held. Now let's have a look very carefully on this. I think let me just slightly zoom it further. Let's have a look out here. Yes, I think that's quite visible well. So let's have a look at all the investments which are held. We can say entity X has got 100% stake in A. It is a subsidiary. And entity X has got a 25% stake in B, which is an associate. And it has also got a 50% stake in, which is a joint venture. Now, let me, I think, clarify a few things. Entity X will consolidate the subsidiary by virtue of Ind AS 110. Entity X will consolidate the associate company by virtue of Ind AS 28. And entity X will also consolidate entity C by virtue of Ind AS 28 because it is a joint venture, not 111, not 111. So he would consolidate the subsidiary applying 110. And of course, first time he would have also applied Ind AS 103 as well for one-time acquisition accounting entry. So associate under Ind AS 28 and a joint venture under 28. Now the question rises, the status of entity Z. Entity X through a subsidiary has got a 20% stake in Z. Entity X through an associate has got a 10% stake in Z. Entity X through a joint venture has got a 10% stake in associate. Now, let's get on to the para number 5. The para number 5 says what? That you've got directly or indirectly. Now, let me first ask a question. Does entity X have any direct stake in terms of Z? No. Entity X has got no direct stake in terms of entity Z. But does entity X have an indirect stake? Yes. Through a subsidiary, through an associate, and through a joint venture. We will not consider through an associate and through a joint venture. We will not consider, as per para number 5, through an associate or through a joint venture. The only thing we will consider indirectly, the only thing which we will consider indirectly is through a subsidiary, which is 20% stake. So he would also account for the associate under Ind AS 28 with only a 20% stake. I will not say that he has got another stake through B or another stakes through C. This is not to be considered for consolidation. For consolidation, only this portion will be taken and Ind AS 28 will apply. I know the next question coming to your mind. You would say, sir, in this particular case, we're pretty safe that entity X has got a 100% stake in A and a 20% stake in Z. So he's indirectly got a 20% stake in Z. Therefore, it became an associate. You would say that if company A, let's say, had less than 100% stake, let's say if this was 80% instead of 100, then he's got indirectly 80 into 20, that is a 16%. Would Z be considered as an associate? I would say yes. You know, when you're looking at the applicability of the standard, you don't need to look at the indirect percentage. You need to look at the total percentage in hand. So to my mind, you know, whether this is a case of 100 or 80% doesn't make a difference. To the extent A has got more than 20% or more than 20%, Z becomes an associate of A. So the moment you can say the subsidiary company is got 20 or more than 20 in Z, then we can say Z is definitely an associate of X. Yes, for the purpose of accounting, for the purpose of equity method of accounting, I would say that yes, X has got, let's say 80%, he's got 80% of 20, 16%. So there are two things. For the applicability of the standard, you got to look at the total percentage. But when you go to account under the equity method, you got to see that indirect percentage. So let's say if this was 80, I would say for the application, whether X has got Z as an associate, I will take 20 as 20. But in order to do the equity method of accounting, I would say X has got 80% of 20. There is 16%. I hope I've made myself very clear. So the main emphasis which I want to give you in terms of para 5 is that if you've got a direct investment, pretty good, but indirect is to be taken only through a subsidiary, not through an associate, not through a joint venture. This was clearly brought out as an explanation in the education material. No worry, I'm going to make a note on that as well. So I think we've got one thing very clear, though we got to see some subjective assessment. Significant influence per se is a rule-based assessment, but it has got its own subjectivity and judgment, because you need to look at parameters given in para number 6 as well. So the clarification number 1, which I gave you, that if you've got 20% or more indirectly, it has to be through a subsidiary, not an associate, not a JV. And this 5 parameters which you need to see, we're going to make a list of them. Let's begin. Let's, I think, first of all, document the notes to you. Then we're going to see some questions based on the para number 6 from the study material as well. So let me just add on some notes now. So I'm coming to the section number 1. This is assessment. This is assessment of significant influence. I'm putting it as SI. You know that I'm talking in terms of significant influence. So we are saying that in this case, there is a general rule. We're saying that there is a general rule in terms of assessment, and that is that if you've got 20% or more voting power, if you've got 20% or more voting power, we can say it is presumed that there is a significant influence. And if you've got less than 20%, if you've got less than 20% voting power, then in this case, it is presumed. Then in this case, it is presumed that there is no significant influence. That's the basic thumb rule which is there, that you look at the apparent percentage. But we also made a mention that this has got exceptions. So there are exceptions. So we will see those exceptions very soon, but these exceptions are, we need to assess the 5 parameters. We need to assess the 5 parameters. I'm just making a reference of para number 6. You need not remember the para number, but I'm just giving you that there are certain parameters to be made an assessment in terms of para 6. And I think if you just make a quick list of those 5 parameters, so we can just make a list of those 5 parameters to be seen. So let's see what are those parameters to be seen. The parameter number 1 is that there is a representation. There is a representation in board of directors. So the investor has got a representation on board of directors. He's got a participation. He's got a participation in policy making decisions. So he's got a participation in terms of policy making decisions, including dividend distributions, etc. Then number 3, we said that there is material transactions with each other. I'm just using the keywords. There are material transactions between the investor and the investee, or there could be interchange of managerial personnel. There could be interchange of managerial personnel. So if there is interchange of managerial personnel, that could also be indicative there may or may not be a significant influence. And the other one is provision of essential technical information. Provision of essential technical information. So these are the 5 parameters of para number 6, which one needs to look into before you assess that there might be a significant influence or not. Now, another important thing which I'd like to add on is in terms of that this 20% or more can be directly. So it can be directly, that's 1, or it can be indirectly. It can be indirectly, and I'm putting the focus very clear, only through subsidiary, only through a subsidiary. So this percentage which is held could be direct or it could be indirect, and the indirect is only through a subsidiary. And I think I'll still like to overemphasize in the brackets, not through associate or JV, not through associate or a joint venture, as we just saw in question number 7. So maybe you could look at the reference to question number 7 for a little clarity of thought later. Okay. So I think this gives me the inputs in terms of the significant influence assessment, that the general thumb rule is 20% or more implies SI, less than 20% no SI, and this 20% or more can be directly held, or it could be indirectly held only through a subsidiary, not associate or joint venture. And there are exceptions, and these are the 5 parameters to be evaluated in terms of exceptions. Okay. I think now let's do some questions with you. Let me first take you to a few questions in the study material quickly on the assessment of a significant influence. I think so far so good. I don't see that there might be any challenge in terms of things so far. Okay. Let's, I think, take the journey forward, friends, and let's go to the study material for some questions with you. So let's have a look at, first of all, there is an illustration number 1 on page 14.144. So this is illustration page 14.144. So let's have a look at the illustration number 1 with you. And let me just read the facts. We'll make an assessment of the significant influence. It says E has got a 25% voting power of an associate. So which means it implies a significant influence on the very apparent level. The balance 75% is held by 3 other investors, each holding 25%. Now, let me also caution something at this stage, because that could be a matter of confusion maybe later. If a particular investor has got control over a company, does this mean that another investor cannot have a significant influence? No. So let's consider a case where, let's say, there is a company A and there is a company B. Company A has got a 60% stake in B, so it's got a control. There is a company C which has also got a 25% stake in B. So the presence of the fact that A controls B doesn't mean that C cannot exercise a significant influence over B. So one of the investors has got a control, another investor has got a significant influence possible. Let's take another case where there is A and let's say there is C, and together they've got a joint control over B. And we've already seen earlier as well, let's say there is D and D has got a significant influence over B. So 2 investors have got a joint control over B. That doesn't mean that D cannot have a significant influence. So there might be an investor with a control. There might be some investors with a joint control over the company, but still it means that you can have a significant influence over B. So when it says that the balance 75% is held by 3 other investors with 25% each, maybe you could see that those 3 investors may be having a joint control over that company, but that doesn't mean that another investor cannot have a significant influence. Just to clarify, the decisions about the financing and operating policies are taken by investors holding majority of the voting power. Since the other 3 investors together hold majority voting rights, they generally take decisions without taking the consent of E. Since decisions are taken by majority, they do not involve him in terms of taking decisions. Participations in the policy-making process seems to be absent. Even if E proposes any changes to the financing operating policies, the other 3 investors do not vote in favor of those changes. Poor man. Even if he says that certain changes should be done, nobody listens to him. They take decisions without his consent. He proposes change and nobody considers his things. So in effect, the suggestions are not considered while taking decisions. So his suggestions are totally ignored in terms of taking decisions, determine whether he's got a significant influence or not. I think he's just a paper investor. It is only on the papers that he's got a 25% stake. But, if you look at the substance, what is actually happening in this particular case, the poor man is not able to exert any kind of significant influence. The other investors do not involve him in any decision-making process, and any changes which he proposes totally ignored. I think he doesn't have a significant influence, because even though on paper he's got more than 20% as a thumb rule, but I think if you start looking at the facts and circumstances of the case, where his involvement in the policy making is not there, he cannot have a significant influence. Since E is holding more than 20%, it indicates that he might have a significant influence. However, the other investors prevent E from participating in financing operating policy decisions. Hence, in this case, he is not in a position to have a significant influence over the investing. So, the standard makes it very clear that it's not a rule-based assessment, but it is supposed to be a principle-based assessment. You cannot simply go with the fact that you've got a 20% or more voting power. You need to look at the facts and circumstances and then take a call whether significant influence is present or not. Okay, so that was, I think, pretty simple indeed. Now let's come to the cases where we would be requiring certain judgments. So as I said, now there will be certain cases where judgments might be required. So when you've got generally, even the previous one, I'm not saying that the judgment was not required, but the level of judgment required was not that high, because the facts and circumstances were very apparently indicating the absence of a significant influence. But sometimes more data, more information might be required, so it might be judgmental in nature. Let's quickly look at some more examples with you. Let me just slightly clear this. Okay, let's have a look at the illustration number 2. It says Cuckoo has got a 12% voting shares in Boho, so which means less than 20%, and Boho board members comprise of 8 members. The company's board of directors is comprising of, it says, a total of 8 members. Let me zoom it further. So it says the company's board of directors is comprising of 8 members, and 2 of these are appointed by Cuckoo. Each board member has got 1 vote in the meeting. Is Boho an associate of Cuckoo? Well, in this particular case, I'm not saying that simply a combination of less than 20% along with the representation on the board of directors is going to be, is going to be a conclusive evidence. But yes, the circumstances is indicating that yes, there is a possibility of a significant influence, because even if you've got less than 20%, but you've got a representation on the board of directors. So Boho is an associate of Cuckoo, and it is demonstrated by the presence of directors on the board and the relative voting rights at all the meeting. So we can say in this particular case, there are a total of 8 members and he can appoint 2 of them. So he's got like almost 25% representation on the board of directors. And I think if the decisions are going to be taken by the board of directors, considering that he's got a 25% representation on the board of directors, I think it would indicate the presence of a significant influence. Because even if you remember in terms of Ind AS 111, your decisions could be on the basis of majority voting rights, or the decisions could be taken by the board of directors. So you could get a joint control or a significant influence, not on the basis of voting power, but on the basis that you've got a representation of more than 20%, say, on the board of directors. Okay. So in this case, let me also clarify, it is presumed that the entity has got a significant influence if you get 20% or more voting power, but it is not necessary to have 20% representation on the board. And this will all depend upon the facts and circumstance. So as I said, that please do not consider the fact that you've got 2 by 8, there is 25% representation. The standard says 20% or more voting power. It doesn't say 20% or more representation on the board of directors. So you cannot take this as an evidence, but you need to look at the facts of the case. One board member may represent a significant influence even if he's got less than 20% voting power. It is necessary to look at the specific facts and circumstances that in this case. So you need to basically see the facts of the case. It can be judgmental in nature. So the thumb rule is based on a voting power. and not on the basis of the representation percentage on the board of directors. Okay, let's have a look at another one. One illustration each is given on all the areas of para number 6. It says M is got a 10% voting power, less than 20, and the balance 90% is held by 9 other investors with 10% each. The decisions about relevant activity of the investee are taken by the members holding majority voting power. The decisions about taking borrowings are required to be taken by the unanimous consent of all the investors. And further, decisions about taking borrowings are not the decisions that mostly significantly affect the return. He says decisions about borrowings are not the decisions that most significantly affect the returns. Now, in this particular case, we can say one of the decisions where a unanimous consent is required if it is considered significant. It says it is not most significant, but yes, it is significant at the same time. So your participation in the policy making along with a percentage less than 20 might indicate that yes, there might be a significant influence. You could fight out these cases with more things as well. But I guess, as I said, it's all going to be completely judgmental in nature. So we're just trying to give examples in terms of para 6 that with a less than 20% along with the participation in the policy process could indicate a significant influence. So in this case, though he's got less than 20%, but the consent is required to take decisions about borrowings, which is one of the relevant activities. Further, since decisions are not the decisions most significantly, it cannot be said that all other investors have got a joint control of the investee. So we can say that the presence of significant influence could come in. Okay, then let's have a look at further illustrations as well. Let's look at illustration number 4. These are examples on each of the items in para number 6. So this is now on the material transaction. Let me slightly clear this out. I'm just quickly running through these illustrations because there is hardly anything on these illustrations, and these kind of subjective questions have never been asked in the exam. So I think we can be fairly comfortable on that situation because too many judgments can be subjective. And therefore, this kind of question is not there. But the illustration number 1, which we saw, is something which can definitely, can be seen in the exam because the level of subjectivity is not very high. These illustrations have been given purely with the objective of understanding and appreciate the essence of para number 6. Though they are subjective, they involve judgment. Okay, so illustration 4, it says RS is an entity engaged in the business of pharmaceutical. It is invested and has got 15% voting power in the company, which means less than 20%. So he's got less than 20% stake in the company. Let's see the other facts. And it says X is engaged in the business of producing packing material. One of the incentives for RS to invest in XY is the fact that he's engaged in the business of producing packing material, which is also useful for RS. Last many years, almost 90% output is procured by RS. They've got a material transaction with each other. 90% output of the investee is being procured by the investor. So they've got certain material transactions with each other. Since 90% output is procured, we can say XY would be dependent on the continuation of the business. Therefore, even though he's got less than 15%, the possibility of significant influence cannot be ruled out. Okay, so we can say that in this particular case, since the survival of the business of XY is quite dependent upon RS, he can definitely significantly influence the company. Next, we give an interchange of managerial person. Entity X and Y operate in the same industry in different geographical regions. Entity X has got a 10% stake in Y as a part of the strategic agreement. A new production process is the key to serve a fundamental change in strategic direction of Y. The terms of the agreement for Y to start a new production process under the supervision of 2 managers from entity X. The managers will be seconded from X, one of whom is on the board of X. He will oversee the selection and the recruitment of the new staff the purchase of the new equipment, the training of the workforce, and the negotiations of new contract. The two managers will report directly to Y as well as to entity X. So there has been evidence that entity X has got a significant influence, and as I said, it is judgmental, but apparently indicating the interchange is indicative. Okay, let's look quickly at another example as well. Let's go to illustration number 6. I'm just quickly making a run through on these illustrations. I don't want to spend too much time on them because they are subjective. So I'm just quickly running them through. Okay, it says in illustration number 6, R is a tire manufacturing entity and they entered into a technology transfer agreement, provision of essential technical information. Y is also involved in the business of tire manufacture. R is established entity in this business, whereas Y is relatively new. As per the agreement, R is granted Y a license to use the technical information and know-how and are related to the process for manufacture of tire. Y is dependent on the technical information and know-how by R, very clearly indicative that there is a dependency in terms of technical information. So it says further R is invested only 10% stake. So with a less than 20% stake, but there is a provision of essential technical information, this might indicate. So Y obtains essential technical information and therefore he can have a significant influence even though the stake is below 20%. I think these are fairly simple examples. So I made a very quick run through on them because we've got a lot of more important agendas for discussion. So let's take a quick recap on what we have discussed so far. Well, I have just given you one input so far, and that is significant influence assessment is per se, on a very apparent level, a rule-based assessment. The standard in terms of para number 5 very clearly brings out that if you've got 20% or more voting power, focus 1, not representation on the board of directors. You've got 20% or more voting power in a company, it implies a significant influence. And if it is less than 20, it means no significant influence. This 20% can be directly held or it can be indirectly held. But what is important is that if it is indirectly held, it is through a subsidiary. Second focus point, that the factors which could challenge the presence or the absence of a significant influence are given in terms of para number 6, and there are 5 parameters. You need to see in this particular case that is there a representation on the board of directors? Look at the facts. You need to see that in this particular case, is there any interchange of managerial person? Is there a participation in the policy making process? Is there a provision of some essential technical information? So the 5 parameters which I gave you could be indicative that there may or there may not be any kind of significant influence. I don't remember that in the examination so far, there has been any questions on area number 1, that is on the assessment of a significant influence. As you know, that it can be a lot of judgments at many cases, but you've got a fair idea. I think let's move ahead. So let's see if there are any questions coming in your mind so far. Otherwise, let's take the journey further. Yes, I think everything going well. Okay, so let's take the journey forward. Now, friends, I think let's do one thing. I think let me first of all take you to the scope. So what do you want me to do? The little technical discussion first, because accounting is not very difficult. So what do you want me to discuss right now at this stage? You want me to discuss the exceptions and the exemptions first, or you want me to discuss the method of accounting? I give you a choice. So discussing the exemptions and exceptions is going to be slightly technical in nature. And accounting is pretty easy because that's just a simple case, just like we make a bank reconciliation. So I'll go with the majority choice. What do you want me to discuss first? So let me see if you got some inputs in terms of very majority decisions. Okay, so I'm yet to get any information on that. So take your call. In the meantime, let me, I think, come to certain relevant portions in the standard. Accounting is pretty easy. So I think I am thinking that we need to first discuss a bit on maybe the exemptions and the exceptions to begin with. Okay, So we've got certain exemptions and exceptions. Yes, I think Namrata tells me let's discuss the exemptions. Okay, so let's take the journey forward. Now hear me very carefully. This is going to be a crucial discussion, friends. We've got para number 17, we've got para number 18, and we've got para number 19. Now this is going to be a slightly technical discussion, but you're going to love it. And I'm going to take good examples to make it very clear to you. So let's begin the journey. Now, hear me very carefully, very, very carefully. I'm going to first read certain inputs given in the standard. We'll take some good examples which are there in the education material. One or two questions are there in the study material as well. I won't take those questions. That you'll be able to easily manage once I'm done with the questions on the education material given on the area of para 17, 18, 19. Now watch the language carefully. The next, I would say, around 20-25 minutes is going to be quite crucial for discussion. So next 20-25 minutes, I need your full attention. Okay, let's begin. The word which is clearly stated is exemptions. The word which is clearly stated is called exemptions. Exemption means it's a choice. Exemption does not mean that there is a mandatory situation. So we can say in terms of exemption, it indicates a complete choice on the part of the investor. It's not mandatory. I give you this situation in terms of Ind AS 110 as well. Exemption means a choice, exception means mandatory. Right now he says exemptions. An entity need not apply. When I say need not apply, it indicates a case of choice. It need not apply equity method to its investment in an associate or JV if the entity is a parent that is exempt from preparing consolidated financial statements by the scope exception in para 4A of Ind AS 110. Now let me visualize the first case which he's talking of. He says if the entity is a parent that is exempt from preparing a consolidated financial statements by the scope exception in para number 4A of Ind AS 110. Let's imagine there is a company A and it has got a control over company B, and there is a company C, and let us say it has got a significant influence over C. Now, in this particular case, let us also consider on the top, there is a company D as well, which has got a control over A. Now, you would recall that para number 4A, you get an exemption only if there is a chain. That's the reason I've taken a chain right now as well. Because para number 4E is applied, it would be applicable towards A when he's a middle company, a part of the chain. So A got an exemption under para 4A of Ind AS 110. So he would also get an exemption from consolidating C under Ind AS 28, para number 17. He says very clearly, if the entity is a parent, so A is a parent of B. So if the entity is a parent and is exempt from making console by virtue of para number 4A, or that is another situation, So if A gets an exemption under Ind AS 110, he also gets an exemption under Ind AS 28, para number 17. I hope that's pretty clear. You don't need to consolidate a subsidiary by virtue of 110. You will also not be required to consolidate the associate under para number 17. So if you get exemption under 110, automatic exemption available under Ind AS 28 as well. Okay, next. It says, or if all the following conditions apply, and trust me, all these conditions are the same conditions which are given in terms of Ind AS 110. They are the same things which are given in terms of Ind AS 110. So in this particular case, it says the entity is a wholly owned subsidiary or partly owned subsidiary. You've taken an NOC, their securities are not listed, they're not in the process of listing, etc. And the ultimate parent is preparing console, whatever. Same parameters which are given in terms of Ind AS 110. That means I can pretty well say, let's keep one situation only, that if you get an exemption under 110, automatic exemption under Ind AS 28 under para number 17, 1. I don't think so. Para number 17 needs any further explanations. Okay, let's go on to the next one, that is para number 18. Now that's an interesting para. Let's have a look at the para number 18. Now let me just clear this bit. And let's see the para number 18 in this case. Now, in terms of para number 18, see what it says. When an investment in an associate or JV is held by or is held indirectly through. Aha. When I say held by, it is directly. When I say indirectly, of course, means indirectly, an entity that is a venture capital organization or a mutual fund, unit trust, and similar entities, including blah, blah, blah. The entity may elect its choice to measure that investment at fair value through P&L, FPTPL, in accordance with Ind AS 109. So he says that when an investment in an associate or JV is held by or indirectly through an entity. So there are two situations I'm looking at. A has got a significant influence over B. A and B and C. A has got a control over B and B has got a significant influence over C. Now watch this carefully. It says when an investment in an associate or JV is held by an entity that is a VC, venture capitalist, or MF, or unit trust and similar entity. If A is supposed to be a venture capital organization, VCO, a mutual fund, or a unit trust. So there are three things. It says that it is a VCO or a mutual fund or a unit trust and similar entities, of course. Then he says you can choose that you want to apply equity method for B or you want to take it at FPTPL, your choice. The standard says that as an investor, if you are a venture capital organization or a mutual fund or supposed to be a case of unit trust, you've got a complete choice to apply equity method of accounting for B, or you can take this investment at FPTPL, your choice. It may. So you can account under equity method, or you may account it under, you can say 109 FVTPL. And then even if it is indirectly, so let's say, for example, A has got a control over B, and in this case, B is supposed to be a VCO, MF, and UT. So in this case, A is not a mutual fund, a venture capital, but its subsidiary is a venture capitalist organization, and A indirectly through B, that is a subsidiary, has got a significant influence over C. Then also A gets a choice. A gets a choice, either he would consolidate C using equity method, or in this particular case, he can choose to apply Ind AS 109. So when you yourself is a venture capital organization, MF or UT, you get a choice, or you've got a significant influence through a subsidiary and your subsidiary is a venture capital organization, you get a complete choice. I hope that is also pretty clear. So I think the para number 18 is very clear. Let's, I think, take it further. Let's take it further, then we'll do some practical illustrations on this. Now let's have a look at what is stated in terms of para number 19, which is a very interesting para, because one of the questions came in RTP on this area, on para number 19, and that is a question in the education material, which is also came in RTP. I think it was 2019, if I rightly remember. It says when an entity has an investment in an associate, a portion of which is held indirectly through a venture capital organization, a mutual fund, a unit trust, etc., it may elect. Now, you need to be careful. Para number 18 is talking of your entire investment through a venture capital, or your direct investment completely when you are a venture capital. So para number 18 is focusing that as an investor, your entire investment is there and you are a venture capitalist, or you've got an investment through a venture capitalist. And in this particular case, there is nothing which is held other than a venture capital organization. Now, para number 19 is telling you when an entity is got investment in an associate, it says a portion, and this is associated, it doesn't talk of joint venture. If you actually look at para number 18, it is talking of a joint venture, but I think I'll not get into too many technical details. But para number 19 is applicable only to associate, mind you. They don't use the word joint venture in this case. When an entity has an investment in an associate, a portion of the investment held indirectly through a venture capital organization, mutual fund, it says entity may elect to measure that portion of the investment at FPTPL in accordance with 109, regardless of whether the venture capital organization has a significant influence over that portion of the investment. If the entity makes that election, it shall apply the equity method to any, it shall apply equity method to any remaining portion of the investment. I think I need to take examples to illustrate this. So let me do one thing. Let me just create some permutation combinations on para number 17, not 17, 18 and 19. So I think I just want to take you once again back, and maybe you can just have a look at a little language further. This time, let's look at things with a little more keen eye. So what I'm going to do, I'm going to show you certain things, but I don't want to take you too deep as well, because otherwise every word can have a significance. But let me just give you something, a food of thought to think upon. See what it says out in para 18. When an investment in the associate or a joint venture, the word is associate and JV both. The para number 18 is talking of associate, JV both. The para number 19 is talking only of associate. It says when an investment in the associate or JV is held by, it's a direct investment, or is held indirectly through. It can be indirectly through. So it can be directly, it can be indirectly. An entity that is a venture capital organization, mutual fund, unit trust, and similar entities. The entity may elect to measure that investment at FPTPL in accordance with 109. So he's made it very clear. He's made it very clear that if A has got a significant influence over B, A directly has a significant influence or a joint control resulting in a JV. I'm just adding a few points. When an investment in an associate or JV, so you've got a significant influence over B, or you've got a joint control resulting in a JV. That's one. And in this case, A is a venture capital organization, mutual fund, or unit trust. Then he has got a choice of applying equity method or 109. Let's get it very clear. When does para number 18 get triggered? There are two things. There are two things in terms of para number 18 getting triggered. Number one, you need to tell me that A has got a significant influence over B, or you need to tell me that A has got a joint control resulting in a joint venture where B is a JV. So either B is an associate of A or it is a joint venture of A. That's one. Second, A is supposed to be a VCO, MF, or UT. Then I'll take A. Okay, you've got a choice. Don't worry, I'll document the notes. Or it could be a case of indirectly through a subsidiary. Indirectly always has to be through a subsidiary. So if A is got indirectly through a subsidiary, where we can say B has got a significant influence or a joint control, making it C as a JV. So B has got an associate or B has got a joint venture, then A gets a choice if B is a VC, MF, or UT. Unit trust, mutual fund, and venture capital. So again, two conditions. B has got an associate or a JV. and B is supposed to be a venture capital, a mutual fund, a unit trust, then I tell A that you've got a choice that you want to consolidate C, equity method, or apply 109. I hope para number 18 is very clear. So direct and indirect through a subsidiary, and it has got entire investment in an associate. It's not like some portion, not through a VCO and some portion through a VCO. So para number 19 is telling us when an entity has investment in associate, the word JV is not written. The word JV is not written. So when an entity has investment in an associate, a portion of which is held indirectly through a VC or unit trust or mutual fund, a portion is held indirectly. It's a further explanation to para number 18 if you see. Now, if you consider the chain, A has got a control in B and B has got a significant influence. There could be two things. A has got a control over B and C has got a significant influence over B. Or maybe A has got, let's say, a significant influence over B. Now you can see, watch this carefully. A has got a direct investment in B. A has got a direct investment in B, significant influence in B. A has got through a subsidiary significant influence. And here we are saying that C is a venture capital organization, etc. So watch this carefully. I'm taking a situation one. A has got two investment direct, where A is not a venture capital. A is not a venture capital in this case. So he is not able to get any advantage of para number 18 in this case. Let's get this very clear. A is not a VC. He doesn't get any exemption under para number 18 in this case because he is not a VC. But in terms of A through C, he wants to get the case of exemption under para number 18. But what is happening? That he's got two investments. One is direct and one is indirect. Para number 18 is telling you exemptions only in one case where you've got investments only through VC. Only through VC, or you're directly yourself a VC, but you've got no other investments without VC. And para number 19 is giving you an explanation where you may have some investment directly without being a VC, but you've got some investments, as a VC. So, and the other case is that you've got a control and then you've got indirect. So let's concentrate on the second one. So when an entity has investment in an associate, a portion of is held indirectly through VC. You've got investments in B, but a portion is held through VC. So I think let's concentrate on that. A portion is held indirectly through a VC or a mutual fund, etc. The entity may elect to measure that portion of the investment at FPTPL. So only this portion will be measured using FPTPL, not this portion. Not this portion. So we will segregate the investments into two portions. One is not through VC and one is through VC. So the portion of the investment which is held through VC, you got a choice to apply FPTPL. And then it also adds on further thing as well. If the entity makes that election, entity shall apply the equity method to remaining portion of the investment. So to this portion, you will have to apply equity method of accounting only. Mandatory. So it is only on this portion that you can choose to apply another thing. And then you also add another thing as well, regardless of whether the venture capital has got a significant influence over that portion. That I'll explain later. That I'll explain later through an example. That there is something which is given regardless of some percentage, we'll see later. So let's get one thing very clear. Let me just create some permutation combinations in terms of this para. So let me, I think, just add the inputs out here. Let's make some permutation combinations to get more clarity of thought in terms of 18, 19. I'm not worried on para 17. I'm looking at para 18 and 19. So let's see the scope of the standard. So we can see that I'm looking at the para number 18. Now, what does para number 18 say? I would take two cases in terms of para 18. I would say case number one, I would say there is case number one, and I would say there is case number two. So case number one is direct. Case number one is supposed to be a direct investment, and case number two is supposed to be indirect investment. So in terms of para number 18, I'm considering two cases, direct and indirect. So very simple. Let's take the two cases. In terms of para number 18, we can say A, and he's got investment in B. Now, A is either got, you can say B is either an associate, B is either an associate, or B is either a joint venture. Let's get this very clear. B is either an associate or a JV. That means A is either got a significant influence over B, or A is either got a joint control over B, resulting in a JV. Let's get this very clear. That A is got either a significant influence over B, associate, or a joint control resulting in a JV. And we are saying A is a venture capital organization or a mutual fund or a trust or UT. Let's put this as a UT. So it's either a mutual fund or we can say a unit trust in this case. So you can see two triggering conditions which are applicable. So B is associate or JV. Mind the words very carefully. B is an associate or a JV, and A is a venture capital organization, mutual fund, or unit trust. Then I would say in this particular case, we can say A gets a choice. A gets a choice in this particular case. What is the choice? That you either apply equity method of accounting, or you follow the concept of FVTPL as per 109. So either you apply equity method Ind AS 28 or you apply FPTPL 109. I hope the case one is 100% clear. So we're looking at the case number one, that is that A is supposed to be a VCO, mutual fund or unit trust, and B an associate or a JV. In this case, A gets a choice. I don't think so there will be any dispute on this para 18 case one. Case two. We are considering now another case in this case, and that is A in B and B in C. Now here again, you need to have a control over B. You need to have a control over B, and C is supposed to be either an associate or it is supposed to be a joint venture, either of the two. So either B has got a significant influence or a joint control resulting in a JV. Get this clear. Parameter number one, that B has got an associate or B has got a joint venture, that is one. And of course, A has got a control over B, that's like two. And B is supposed to be a venture capital organization or a mutual fund or a unit trust. Then also A gets a choice. Then also I'm saying A gets a choice. Let's get the position very clear. I think in order to avoid any mistakes, we can put it like this, that in case number one, there are two parameters. Number one, B is an associate or a JV of A, one. A is a VCO, MF, and UT2. Then A gets a choice. Case number two, I can say three parameters. C is an associate or a JV of B. A is got a control over B. And number three, B is a VCO, MF, and UT. A gets a choice. Trust me, this is a simple explanation to the para number 18, that there are two parameters in case one and there are three parameters in case number two. If it is a case of indirect, you need to see that A should be having a control over B, B should be having a significant influence or joint control over C, and B should be a VCO, MF, or a UT. Then A gets a choice. I hope, friends, I am 100% clear on the para number 18, I guess. Right now, let's take it further. Let's now go to the para number 19. So we'll take only one example in terms of para 19, not taking many cases and confusing things. Let's take only para number 19 in this case. One particular case on para 19, so that we get a clarity on the things. Now, let's consider that there is company A, and let's consider there is B, And let's consider there is C, and let's consider C is got in D. I think let's create a better diagram so that you can see things clearly, because arrows might not create a problem later. Let's make it a bigger chain. This is B, and let's say this is C, and I think let's consider this to be the case. Yes. Now let's have a look. We can say A is got a significant influence, so B is an associate. Let me remind you back again, the concept of para number 19 is not applicable to JV. It's not applicable to JV. Now let's get the focus very clear that there is direct investment, and we can say A has got indirect investment through C. So this is a case of control, and this is a case of a significant influence. Now, I think let's get the chain very clear in terms of para number 19. Watch this carefully. A has got investments in two parts. In terms of para number 19, A has got investments in two parts. One is direct and one is indirect. So para number 19 applies when you've got something indirectly as well. When you've got something indirectly as well. So in this case, we are saying C is a venture capital organization, mutual fund, or a unit trust. Wow. Now this becomes an interesting case. A has got a direct investment. So in this particular case, the portion which is direct, you need to apply equity method under Ind AS 28. So there are two portions of the investment. Portion number one, you need to apply Ind AS 28, mandatory equity method to be applied. Then there is indirect portion through a venture capital organization. That indirect portion, you get a choice. You get a choice in terms of applying Ind AS 28 equity or FPTPL. You've got a choice. I hope I'm clear. So let me make it very clear that para number 19 does not focus on a joint venture, totally focuses on an associate. So you must have investments in two portions. Para number 19, you must have investments in two portions. So triggering parameters, you have two parts. One part where para 18 does not apply. So one part where you can say the para 18 does not apply, and another part to which para number 18 applies. So you need to get this very clear that you've got two portions of the investment, one portion where para 18 doesn't apply, equity method, another portion to which para 18 applies. And in terms of para 18, they're taking the indirect case, not the direct case as such. But we'll see. But what you need to remember in terms of para 19, that you've got investments in two parts, not single. This was single. This is single. This is two parts. So para 19 applies when you've got investments in two different parts. One part to which para 18 doesn't apply, equity method to that part. One part to which para 18 applies, you get a choice. I hope I'm clear. Right? So this is the crux in terms of para 18 and in terms of para 19. So remember one thing, that para 18 would apply only when it is a single investment, no portions. Para 19 would apply when there are portions. So I'm going to now take you to questions where we're going to see that is it a case of portion of investments or is it directly one? So if it is a single investment, direct, indirect, then it is 18. But if it is two portions of the investments, one is through VCO, then para 19 applies. And accordingly, we need to apply different standards to different portions of the investment. But remember, para number 18 and para number 19 is giving you a choice. And let me tell you one thing, friends. There is one very interesting situation given in education material where para number 18 and 19 becomes mandatory. Oh my God, you heard me correct. I'm just wondering, when the MCQ portion starts in the new course, there can be wonderful questions given if we get some true and false question. And one of the questions can be, can the para number 1819, which is apparently gives you a choice, can it become mandatory? Can an exemption turn to an exception? Wow. I'm going to give you that today. So I think now with this input, let me just have a look at a few questions with you. So let me just take you to a few questions at this stage. Let's first of all have a look at one of the interesting questions. I'm taking you to the study material, I think. Let me just take you to the study material maybe. So there is a little question. No, this one, sorry. Let's, I think, go to this question. This is education material. It came in RTP May 20. This question came in RTP in May 20. It's in the education material as well. Let's have a look. There are three situations which are given. Let me see if there is any further question as well. Yes, there is another question as well. Okay, first we'll look at question number 5. And then we'll look at the question number 6. Okay, let's have a look at question 5 first. So we'll do two questions with you. One is question 5. And one is question number 6. They're both in the education material. Interesting question. You'll be able to manage the questions in the study. Let's have a look at the question number 5. It says ABC operates a pharmaceutical business and owns a venture capital organization subsidiary V. ABC has got a subsidiary V, which is a VCO. Okay. So there is a control. Let me put it out here. There is a control. So ABC has got a control over a company, VCO, that invests in the construction industry. V's business is monitored on the basis of fair value of the investment. ABC and V have got 20% shares each in Z. He's got 20% in Z. He's also got 20% in Z. Okay, now let's have a look. Significant influence is getting created by this. Now, I want to first of all ask you something, friends, and you need to answer this carefully. If you can answer this, the concept is going very good. Is it a case of para 18 or 19? ABC has got one portion of the investment to which para 18 does not apply. ABC has got another portion of investment to which para number 18 applies. Is it a case of para number 19 or not? I think I've already given you the answer. So ABC has got two investments. One is direct, where para 18 is not applicable because ABC is not a VCO, etc. And he's got another investment indirectly through a subsidiary, which is meeting the para number 18 condition. So is it a fit case of para number 19? Yes or not? Let's see if we get the answers on that. Very good. That's absolutely correct. Yes, it's a clear-cut case of para 19. So we can definitely say that there are two portions of the investment. We can say there are two portions of the investment. We can say one portion to which para number 18 is not applicable, and another portion to which para number 18 is applicable. So these are the two portions. So as far as ABC and Z is concerned, ABC and Z directly is concerned, can I say to this portion, you need to apply Ind AS 28. Equity method would definitely apply in this particular case, undoubtedly. In terms of this portion, can I say which is ABC through V? Which is ABC through V. In this particular case, we can say we get a choice. Either you apply Ind AS 28 or you apply Ind AS 109. That means either equity method or FPTPL, you've got a complete choice in this case. So either you apply to both the investments equity. This is in any case mandatorily equity, but this is something where you got a choice either equity or FPTPL. You got a complete choice in this particular case. That was one plain vanilla case of para number 19. Let's look at a little more complicated case. So let's go to the question number 6 now with you. So let me take you to the question number 6 now. And this is another very interesting question indeed. It came in the RTP in May 2020, and it's there in the education material as well. I think I'll just need to clear this bit. And let's see, different scenarios are given. So we'll make an analysis of the different scenarios given. Let's have a look at the question number 6 now. Now, in terms of the question number 6, it gives you the input. Entity P has got two wholly owned subsidiary X and Y. So P has got two wholly owned subsidiary. Let me start making a chart. P has got two wholly owned subsidiary, that is X as well as Y. So this is 100% and this is 100%. And then it says each of which has got an ownership interest in associate entity Z. So they both got a stake in terms of Z. They've got a significant influence over Z. So you've got two subsidiary, X and Y, and each of your subsidiary has got a significant influence over Z. Subsidiary X is a venture capital organization. So X is a VCO. Neither of the investments held in Z by subsidiary X and Y is held for trading, because if it is held for trading, then you need to account under FPTPL. So it says neither of these investments is held for trading, and the subsidiary X and Y account for the investments at FPTPL in accordance with 109 and use equity methods in accordance with Ind AS 28. So it says subsidiary X and Y are accounting for these investments. It says using FPTPL and equity method in accordance with 28 respectively. So X and Y are accounting under different standards. How should P, we're looking at how should P account for the investment in associate Z. Now, I think before we go further, let's get one clarity. Can I say P has got investment in Z, one portion, another portion, right? Is it again a case of para number 19? He's got investment in Z, but he's got investment in Z in two portions. One is through X and one is through Y. Am I right? So is it again a case of para number 19? Yes, undoubtedly a case of para 19, because there are again two portions of the investment. Remember, the concept of para number 19 is triggered only when you've got two portions, because para number 18 is only talking of one portion. Either you yourself is a VCO, etc., or your subsidiary is a VCO, etc. But it's only one channel, one single investment. But in this case, you've got two investments, one portion through VCO, to which para 18 applies, and one portion which is to which para 18 doesn't apply. So that is also one thing to be watched out, that one portion to which para 18 is applicable, another portion to which para 18 is not applicable. Now, he is going to give us three scenarios. We know one thing very clear, that to this portion, you get a choice, and to this portion, you need to apply equity method. So the portion through Y, equity method mandatory. The portion through X, you got a choice, equity method or FPTPL, your choice. Now, let's see the three scenarios. Scenario number one, both investments in associate result in a significant influence on a standalone basis, which means it says X and Y is got 25% and 20% in Z. So on a standalone, X has got more than 20. On a standalone, Y has got more than 20. Let me clarify one thing. It does not make a difference whether you get individually more than 20 or not. What is important is that the sum total of X in Z and Y in Z should be 20 or more. I repeat. What is important is the sum total of X in Z and Y in Z is 20% or more. The individual breakup is 20 plus 10, 10 plus 20, 10 plus 10, 20 plus 20, doesn't make any difference. Whether on a standalone basis, you get a significant influence on one portion, on a standalone basis, you get a significant influence or not, doesn't make a difference. There should be a significant influence in entirety. So if I add up the percentage of X plus Y and it is 20% or more, significant influence is present. Now, the case of applying one portion a choice and one portion the equity method remains. Whether you've got less than 20 here or whether you've got less than 20 here, but the sum total should be 20 or more. So you get individually in one portion below 20 doesn't make a difference. More than 20 doesn't make a difference. So he's now giving you three scenarios. If both investments result in a significant influence, well, you still get the same answer. This part, you get a choice. This part, equity method mandatory. When neither of the investments results in a significant influence on a standalone, but they do provide parent with a significant influence on a combined basis. This plus this is 20, but individually it is, let's say, 10 and 10. Doesn't make a difference. 15 plus 10 doesn't make a difference. Okay, the answer still remains the same. Scenario 1 and 2 answer remains same. Third, one of the investments results in a significant influence on a standalone basis and the other investment does not result in a significant influence. So here it said 10% each. Here it says that there is 30 and 10. Doesn't make a difference. So the clarification which was given in para number 19 was regardless of the investment. It said regardless of the investment. So what is important is that the sum total of these percentages, should be 20% or more. Individually, it is less than 20. I don't care. Okay, now I think it's time to do a little consolidation in terms of a thought, but I hope I am pretty clear on this so far. So let me, I think, do one thing now, friends. I am just going to consolidate the learnings on the scope of the standard. So let's do one thing. Let's, I think, make a mind mapping to you. I've already done this, but I just want to add another mind mapping so that everything is 100% absolutely clear. So I'm just going to create a quick mind map on the second area of discussion so that there is no trouble at all. Because para number 18 and para number 19 is a crucial para telling you the cases where the exceptions happen. So you were about to tell us a particular case where para 18 turns mandatory as well. I will come to that very shortly after the mind map. So I'm looking at para number 18. And I'm looking at a concept of para number 19. So let's get some clarity of thought. Let's get some good clarity of thought. If you're looking in terms of para number 18, let's first of all make it very clear that in terms of para number 18, I see two situations. And in terms of para number 19, also, I'm going to give you two situations based on our discussions. So let's take a situation number 1 and let's take a situation number 2. And here also a situation number 1, and let's also take a situation number 2. Now, you could see various combinations, but just on a very apparent level. Let's say we've got A, let's say we've got B, let's say we've got A, let's say we've got B. Get the focus points very clear. Let's say we've got A, and we've got investment in B, and let's say we've got C, and he's got investment in B. Or let's say we've got A, let's say we've got B, and we've got C, and let's say we've got D, and let's say we've got D. Now, watch this very carefully. The inputs I'm going to give you, you're going to get 100% clarity based on this. Let's begin. Let's begin with the first inputs to you. In this case, B is an associate or a JV. That's 1. B is an associate or JV. That's 1. A is a venture capital organization, mutual fund, or a unit trust. That is 2. So there are two parameters. There are two parameters, but a single investment. Para number 18 is a case of a single investment. And para number 19 is a case of, you can say, multi-investments, which means it has got at least 2 portions. That is one distinguishing criteria. So there are got 2 parameters. B is an associate or JV. A is a venture capital or a mutual trust in this case. So we can say A gets choice. A gets a complete choice, either 28 or FPTPL. Choice. He gets a complete choice, either FPTPL or equity method. Done. Now, let's come to this situation number 2. In this particular case, we are again saying that B is an associate or a joint venture. And let's take another chain as well. Here we need to take another chain as well. Sorry, let me just clear this. Let me clear this. So we're looking at another chain, A and B and C. Now, let's have a look at this. Number 1, we are saying in this particular case, A is an associate or a JV. That's 1. Number 2, B is supposed to be a venture capital organization, mutual fund, or a unit trust 2. And number 3, A's got a control over B. That's 3. So you need to look at the parameters very carefully. C is an associate or JV, 1. B is a VC or mutual fund 2, and A's got a control over B. Then again, we can say in this case, A gets a choice. A again gets a choice in this particular case. He gets a choice of equity method, or you can say FPTPL. Simple and straight. Para 18 is pretty simple and straight. Now let's go to the para number 19 and look at the inputs in terms of para 19. B is an associate, not a JV, not a JV. That's focus 1. So B is an associate. So he got a significant influence. He's got a control here, and he's got a significant influence. So what is important is that C is supposed to be a mutual fund, a unit trust, or a venture capital organization. So you can see that what is important is number 1. Number 1, what is important is 2 portion. What is important is 2 portion. And out of the 2 portion, we can say 1 portion para 18 not applicable. So on 1 portion, para 18 not applicable. And we can say on the 2nd portion, para 18 applicable. So this is what you need to see at the first instance. So you need to see at the first instance, number 1, you need to see that there are 2 portions, 1 portion para 18 not applicable, another portion to which para 18 applicable. So that is the main focus. If that be the case, then we can say A in this particular case, what he's going to do. Can I say to one portion of the investment, he has to apply 28, this portion 28, and to the other portion, he gets a choice. And the other portion, he gets a choice. So to the portion to which para 18 not applicable, equity. To the portion where para 18 applicable, you get a choice. This is the clarification. Simple. So you need to get the focus very clear. The triggering of para 19 says that there are 2 portions, one to which 18 not applicable, one to which 18 applicable, and then you can decide. And no JV, only associate. Let's look at the second example as well in this case. So in this case, A's got a control. A's got a control. And this is significant influence. That means it is associate, not joint venture, So in this particular case, one of the companies, this is supposed to be a venture capital organization, mutual fund, or a unit trust. Same logics equally applicable. One portion which is para 18 not applicable, one portion para 18 applicable. That's the triggering point. One portion with para 18 not applicable, another portion para 18 applicable. The same results would apply in this case as well. So here you can make references to what we have covered in, I think, question number 6. The question number 6 is covered out here, and here I think we covered some of the questions. So this is the area of coverage. So para number 17, 18, 19 gives you the inputs on that area. This is done. Okay, so I think now at this particular stage, before we take you to the exception question, which is in the education material, I don't want to take it up at this stage, but I think we need to now get on to accounting because we've got a little more things to do on accounting, including the long-term interest. So let's not get into the PhD of the exception, but I'll show you that question is there in my assignment. You can maybe make a reference to that question in the education material where the para number 18 becomes mandatory in that case. It's not given in the study, but it's been given in the education material where for extra references purposes, you must have a knowledge where para number 18 becomes mandatory. Because what we've seen so far is that para number 18 and 19 is purely a case of choice. But if, it turns out to be a situation of an investment entity where para number 4B of Ind AS 110 gets triggered, then para 18 can also become mandatory. I'll tell you the question later on that. But I think so far so good. I think let's give you a break now, and then we can start with the aspect of our discussion further. So I guess it's almost 8:45, so 10-12 minutes, friends, and then we're going to start with the accounting under equity method, which is pretty easy. I've given you a little flavor of that equity method of accounting earlier as well, but we're going to still have a look at the equity method, and then there is long-term interest appendix A. Pretty simple. I think we should be able to do it in an hour's time or so. So let's give you a break, friends. Enjoy your break, and I'm going to join you, friends, after the break now. Relax your minds. Welcome back, friends. So I guess your mind is at rest. Now we can start the accounting. As far as the equity method is concerned, I have done two areas of discussion with you so far. One is the assessment of significant influence, and which is, of course, a principle-based assessment. And then I've covered with you the aspect of the scope of the standard, wherein we saw certain cases of exemptions which are given in terms of para 17, 18, as well as 19. Okay, now let's come on to the discussion as far as the accounting under the Ind AS 28 is concerned. That's called the equity method of consolidation. So let me, I think, illustrate this consolidation technique to you. And let me just take a simple example to illustrate the inputs. Well, whenever I do the equity method of consolidation, it always takes me back to school days when we used to do a bank reconciliation statement. And trust me, the accounting is absolutely quite similar. But just hear this, 5 minutes, you'll get the essence of the entire accounting. Let's take a simple example to understand the equity method of accounting. Let's consider that there is a company A and that is invested in company B, let's say a 25% stake, and let's consider it gets a significant influence as well. And this investment is, let us say, bought at a cost of 30 lakh rupees. The net assets of B at fair value, mind the words, at fair value, on the date of acquisition, let's say, is to the extent of 100 lakhs. Here I'm giving you the status of the net assets of B at a fair value. So this is the net assets of B at a fair value on the date of acquisition, that is 100 lakh. Now, if I ask you at this particular stage that what is the amount of goodwill or the bargain purchase gain, you could just apply the principles of Ind AS 103. Not that you're going to take any NCI, but you can simply calculate the amount of goodwill and you can say that we acquired the shares at a consideration of 30 lakhs. And in return, you are getting a 25% share in the net assets, that is 25 lakhs. So we can say we get a goodwill to the extent of 5 lakhs. This is what the amount of goodwill arises at the stage of initial recognition. Well, I would say in equity method of accounting, I would segregate the accountings into two stages. The accounting can be discussed in two stages. Stage number one. The stage number one is that you're looking at on date of acquisition. So on the date of acquisition, what you need to do, you need to identify the goodwill or the amount of capital reserve as the case may be. So like in this example, we can compare the cost versus the share in the net assets at a fair value on the date of acquisition, and we get the amount of goodwill. So that is stage one. You just need to identify that what is the goodwill, the premium paid, or the capital reserve, the gain on acquisition. Now, if you were to ask me to prepare a consolidated balance sheet on the date of acquisition itself. So let's say, for example, if somebody tells me that make a consolidated balance sheet on acquisition date itself, what I'm going to do in the balance sheet, I will reflect in the consolidated balance sheet, the investment in the associate company would appear at the cost itself. And this goodwill computed is going to be reflected as a disclosure in the inner column. The carrying value of the investment would appear. The carrying value of the investment would appear at 30 lakhs itself, but I will disclose in the inner column that there is a goodwill to the extent of 5 lakhs. In other words, if somebody wants to understand the breakup of this 30 lakhs by looking at the goodwill of 5 lakh, he will be able to understand that there is a share in the net assets to the extent of 25 lakhs. And you paid a premium, that is goodwill, to the extent of 5 lakh rupees. So this is what apparently one can interpret looking at the consolidated balance sheet. So you can say that if on the date of acquisition, you were to look at a separate financial statements, the investment would be appearing at 30 lakh itself. Mind the words carefully. I'm saying if on the date of acquisition, you look at a separate financial statements, the investment would be appearing at 30 lakhs itself. even on the consolidated balance sheet on the date of acquisition, you would be reflecting the investments at 30 lakh itself. The only difference is that you will be reflecting this goodwill as a separate disclosure in the inner column. The goodwill does not appear as a separate line item in the balance sheet, mind you. It is going to be disclosed separately, but as a part of the carrying value of the investment itself. So anybody reading the financial statements will quickly analyze that 30 minus 5, the share in the net assets is 25 lakhs and the goodwill is 5. So this equity method of consolidation, technically is called one-line consolidation. This equity method is called a one-line consolidation because you're representing the investment in a single line. Remember, if you look at the consolidation under Ind AS 110, what do? You aggregate all the assets and liability and reflect an NCI. But the essence is what? That you're reflecting the share in the net assets because you aggregate all the assets and liability 100% with the NCI. So in effect, the consolidation is equal to the share in the net assets and the goodwill appears. So in consolidation in 110, what is the essence of consolidation? Investment gets eliminated. The net assets are aggregated with NCI, which means share in the net assets and a goodwill. Here again, the same thing has been done, but there is no aggregation in terms of line-to-line assets and liability. It's a one-line consolidation where the investment will always appear equal to the share in net assets plus the goodwill. Stage 1. Then comes the stage number 2 in terms of accounting, and in terms of the stage number 2, we need to consider the post-acquisition changes. In the stage number 2, we need to consider the post-acquisition changes, and how the post-acquisition accounting is done is pretty simple. Now, for the post-acquisition changes, watch me carefully, and this is what you're going to do. Let's consider the two hands with us. One is investment and the other is the net assets of the associate. So you're going to keep a track of the movements. So what we're going to do, this is investment in the books of the investor, and this is the net assets of the associate company. Now, what you need to remember is a golden rule for post-acquisition changes. If the net assets of the associate company goes up, you need to increase the value of investment, but not by the increase in net assets, but by the share in the increase. Get this very clear, that if the net assets of the associate company goes up, I need to increase the value of the investment to the extent of share in that increase. If the value of the net assets goes down, you need to bring down the value of investment to the extent of share in that decrease. So every time the net assets of the associate company moves up, the investment should increase by the share in that increase. Every time the net assets of the company goes down, you need to bring down the investment to the extent of the share in the decrease. Mind the words carefully. So in a post-acquisition changes, you need to see the movement of net assets. You need to see the movement of net assets of the associate company. If the net assets increase, you got to increase the value of investment. But the increase is equal to the share in that increase. If the net assets of the associate company goes down, you need to decrease the investment to the extent of share in the. So one thing is very clear, that if you say that the investment is supposed to be increased, then in this particular case, what you need to do, you need to basically debit the investment account. And if the investment is to be decreased, you need to basically give a credit to the investment account. An increase in the investment is put the entry investment debit. A decrease in the investment would mean give an investment a credit. The question rises, where do you take the corresponding credit? The question arises, where do you take the corresponding debit in this particular case? So where is the corresponding credits and debits to be taken? Now, the rule is very simple. You get this in the next 1 minute. What do you need to do in this particular case? You need to see that when the associate company increases in the net assets, did the credit go to the P&L? I will give a credit to the P&L. Did the credit go to the OCI? Then I give a credit to the OCI. If the credit went to equity, directly SOKI, then I will give a credit to SOKI. So you need to see that the change resulted in, recorded in the books of the associate in the P&L or the OCI or the equity. So I'll give you example. So basically this debit or credit will either enter the P&L or enter the OCI or enter directly the equity. That is so key. I think let's take some examples to understand this bit. There is one very interesting illustration in the study material which relates to the concept of credit to equity. As one of the questions in the education material, and it's there in the study material as well, which gives us a very good insight that when the entry is investment debit and equity gets a credit. Let's take a few examples to understand this. Let's say the associate company, let's consider that the associate company, let us say, earned a profit, and in the profit and loss section, they got a profit of 2 lakhs. And in the OCI section, they got a profit of 3 lakhs and the total profit is 5 lakhs. Let's consider that we've got a 25% share in the associate. So let's say, for example, in a post-acquisition period, the associate company earned a profit. So the profit they earned in the profit and loss section is, let's say, 2 lakh, and the profit in the OCI section is 3 lakh. Therefore, the profits of the company increases by 5. Now, watch this carefully. Can I say if the net assets of the associate company is seen due to the earning of profits, the net assets goes up by 5 lakh. And therefore, I also should record 25% of 5 lakh. The investment will be given a debit to the extent of 25% of 5 lakh, that is 1 lakh 25. But where will the corresponding credit go? I will take 25% of 2 lakhs and that will be given a credit in the P&L. I will take a share of 25% in 3 lakhs and that will be taken in the P&L, in the OCI. So the corresponding credit 2 lakhs into 25% in the P&L, the corresponding credit 3 lakhs into 25% is going to be taken in the OCI. So you need to basically see that in the investee's books, he's given a credit to P&L, so investment to P&L. He is given a credit to OCI, investment to OCI. He is given a credit to equity, investment to equity. He's decreased P&L, P&L to investment. He's decreased OCI, OCI to investment. He decreases equity, then I would also take equity to investment. So the concept is very simple. You need to consider only 2 things for the application of equity method of accounting. You just need to consider that the post-acquisition changes resulted in increase or decrease in net assets. Increase means investment debit. Decrease means investment gets a credit. And the corresponding debit or credit will enter the P&L, OCI, or equity as the case may be. I think let's have a look at a practical illustration with you with this application. So we can say that this is the post-acquisition changes. So once you make the balance sheet, I can also tell you one thing very clear. I think this is going to be very helpful indeed. So let me tell you one thing very interesting indeed. At any point of time, I'm giving you a very important agenda, very, very important agenda. At any point of time, if you want to match that the investment in the consolidated balance sheet is right or wrong, do one thing. You can always make a cross-check in the balance sheet at any given point of time. The investment in the consolidated balance sheet will be equal to the share in net assets of the associate plus the amount of goodwill identified on initial recognition in stage 1. At any stage you want to make a check that the investment is correct or not, just calculate the net assets of the associate company on that particular date, get the share in the net assets of that company and add the goodwill identified. You will be able to match the investment. Trust me. Any point of time, just calculate the net assets of the associate company, get your share in that, add the amount of goodwill or minus the amount of capital reserve on the initial recognition. You get the investment value as on the consolidated balance sheet. Simple and straight. Okay, I think this should be pretty simple and straight indeed. Let me see if any questions coming in. No, nothing so far. I think it's all pretty okay and comfortable. So let me do one thing now. Let me take you to some illustrations which are given in this study mat. And we'll have a look at a few illustrations, 1 or 2 illustrations in terms of how the accounting is done. So So let's, I think, take you to a practical illustration on this. So I think let's take an interesting question. And one or two things I'll explain directly with the illustration itself. This is on page number 14.153. So let's have a look at illustration number 10 on page 14.153. Now, watch me carefully, friends. There is one thing which I need to tell you, which I didn't tell you earlier, but I'll explain in the question itself. So let me just read the facts of the case and then we'll solve. It says Blue acquired 25% equity share capital of Green on the first day of the financial year for 1,25,000. As on that date, the carrying value, that means the book value of the net assets is given, that is 3 lakh, and the fair value is given, that is 4 lakh. Now, if you remember carefully, when I explained you the stage number 1, I very clearly said that you need to compare the consideration versus the share in the net assets at a fair value. I'm not concerned with the carrying value of the net assets. I'm concerned with the fair value of the net assets. So if I want to calculate, for example, I can say that out of 4 lakh rupees of net assets at fair value, you get a 25% stake in the company, which comes out at 1 lakh rupee. The consideration paid is 1,25,000. So if the consideration paid is 125, you can easily identify that there is a goodwill to the extent of 25,000 at stage 1. So investment would appear in the balance sheet at 1,25,000 in the outer column, and the goodwill will be represented in the inner column of the balance sheet. Okay. Then let me now also tell you something. Now, in this particular case, we can say one thing, that the carrying value of the net assets was 3 lakh and the fair value is 4 lakh. This means that there must have been some asset taken at a fair value. Let's say if there is a PPE which is taken at a fair value, that means you've taken the PPE at a fair value. So there is a need to consider additional depreciation as well. Since the associate company is recorded the asset at 3 lakhs only, they would continue to charge a depreciation on 3 lakh itself. But for the consolidation point of view, since you're considering the net assets to be 4 lakh, you need to consider the additional depreciation as well. So means what? In the post-acquisition period, the associate company's profits will be given, but those profits will be after charging depreciation on book value. I repeat. Can I say in a post-acquisition period, he will give you the status of the profits earned by the associate company, and the profits the associate company earned is based on a depreciation on a book value. But you need to consider a depreciation based on the fair value. So before you consider the share in the profits of the associate company, you need to get the rectified profit after considering additional depreciation. So you need to remember that when you are going to compare the fair value of the net assets share versus the consideration, you need to remember that due to this fair value changes, there is a need to consider additional depreciation as well. So when I say that the associate company earned a profit, that is a book profit after considering depreciation based on a book value. But I need to first of all get a rectified profit after considering additional depreciation and then take a share. Let's see further. It says the excess of the fair value over the carrying value is attributable to one of the buildings owned by Green, and the remaining life of that is 20 years. And therefore, it means that since you revalued the asset by 1 lakh rupee, we can say 1 lakh rupee is the increase to be spread over 20 years. We can say 5,000 is supposed to be the additional depreciation, which I will consider in terms of calculating the profits. Then he says Green earned a profit of 40,000. This is a profit after considering depreciation on 3 lakh. But we need a profit which is after considering depreciation on 4 lakh. So we will take the profit not as 40, but we will take the profits as 35. So remember, this is one important thing, that when you consider the post-acquisition profits, you need to rectify the post-acquisition profits on account of any additional or excess depreciations. And then it says other comprehensive income of 10. So they've earned a profit of 40 in the P&L section and 10,000 in the OCI section. Calculate the goodwill or capital reserve on the date of acquisition, that we've already done, 25,000. and blue share in the profits and OCI for the year and the closing balance of the investment at the end of the year. Now, let's do one thing. We've done stage 1 and stage 2, though the workings are clearly given, but I just like to quickly, give you some inputs and see the presentation which follows. So what I'm going to do in the examination, I would advise what you need to do in the examination as well. You need to go stage by stage. Let's go to the stage number 1. The stage number 1 is the date of acquisition. And you just need to identify the goodwill or the bargain purchase gain. So we will say, okay, what is the cost of the investment? It was acquired at 125 versus the share in net assets at fair value. The share in net assets at a fair value, which is 4 lakh rupees into 25%, that works out at 1 lakh rupee. So we will get the difference, 25,000. That is the amount of goodwill. So this is the goodwill identified on the date of acquisition. Stage 1 is done. Investment is 125 and including goodwill 25. So we can make a mention that investment is 125 and this is including goodwill. This is including the goodwill identified to the extent of 25,000, disclosure in the inner column. Now let's go to the stage number 2. Now, in terms of stage number 2, we're looking at the post-acquisition changes. We're looking at the post-acquisition changes, and the only movement is given is the profits earned. And there is a profit earned in the P&L section and in the OCI section. So let's do one thing. Let's give you some journal entries to get more clear understanding. So one thing is very clear, that since the associate company earned a profit, the net assets went up, investment should increase by the share. So we put the entry investment account debit. The share in the profit and loss will be given a credit in the P&L. The share in the OCI will be given a credit in the OCI. So we will increase the value of investment with a corresponding credit in P&L because they earned a profit of 40,000 in P&L section. They earned a profit of 10,000 in the OCI section. So what do? We take 10,000 into 25%. But when it comes to the profits in the P&L, we need to reduce the additional depreciation, get the rectified profits. That is important. Get the rectified profits and then take 25%. So this will become 35,000 into 25%. That's 8,750. And this is supposed to be 2,500. So we can get the investment increase 11,250. So we can easily calculate the value of the investment for the balance sheet point of view. So the investment is now standing at 125 plus 11,250. So 125 plus this is 136,250 at the end of the year, making a mention that this is including including goodwill to the extent of 25. Simple and straight. So the basic idea is, what you need to remember in this case is that when you consider the profit and loss, you need to consider the profits, which is rectified profits. So this is the important thing, that you need to consider the rectified profit, which is after additional depreciation. Due to revaluations of the asset, there will be a need to adjust the additional or the excess depreciations, if any. That's important to remember. Pretty simple and straight. So that is how the accounting in terms of the investment is done. We can just quickly run through the solution as well, though I've already presented it. So this is the figure of 25 goodwill. Then let's have a look further. And I guess we can have a look at the value of the investment, though I've given you the entries for clarity of thought. But you can see very clearly in this case, the workings have been done. So to this value of investment, we have added the share in post-acquisition earnings, which is after depreciation, and the share in the OCI. That's how the value of investment is appearing. So we have taken the entry investment to P&L for the increase in the profit and loss share. We have taken the entry investment to OCI for the share which is in the OCI. I think it would be incomplete journey if I don't take you to that illustration which is meant, where a credit to equity is taking place. So let's have a look at another illustration in the study mat where we are given the application of the equity method. That's illustration number 12. So this is a beautiful illustration, and this is also there in the education material, and it's there in the study material as well. I think one of the very interesting questions which gives us that corresponding credit goes to equity. Okay, let me just read this bit to you. It says A has got a 20% equity interest in B as an associate, and in turn, it has got 100% equity in C. It's a chain. We can see that A has got a significant influence over B, that is a 20% stake, and B has got a 100% stake in C, that is a subsidiary. Wow. So the chain is interesting. Associate, and then there is a subsidiary. Entity B recognized the net assets relating to C 1000 in its consolidated financials. And then it says entity B sells 20% stake in C to a third party, that is NCI. Now we need to understand one thing based on your understanding in Ind AS 110. If you sell off a stake in the company, a partial disposal, but the control continues, you would remember that if the control continues, then in that particular case, it is considered as a transaction between shareholders of the company. And the simple entry is bank debit, NCI credit, and the profit loss goes in equity. It is directly taken to equity, gain or loss. And in this case, you had 100% stake in the company. And if you sell 20% stake, the control still continues. So it is going to be treated as an equity transaction as per 110. So it says you sold 20% of the stake for 300 and you recognize this as an equity transaction in accordance with Ind AS 110, resulting in a credit which is 100. Now we given that in this particular case, it sold the investment. So the entry he might have done is bank gets a debit. The investment was sold for 300. And then it says that the credit of the NCI is equal to the share in the net assets. So we can say the net assets is 1000. So 20% NCI increase, and you take the balancing figure. The balancing figure gain is taken directly to equity. So this is the accounting which B did when it sold a 20% stake in C. So when B sold a 20% stake in C, this is the transaction which he did. The financial statements of A and B before and after the transaction is given. So let's have a look at the consolidated financials of A. A is on the top of the chain. So what A is doing, it is reflecting investment in B at 200, which is, you can say 1000. Net assets of B into 20%, that is 200. It seems that there is no goodwill at this stage. It seems that there is no goodwill because what he has done, he's reflecting the investment equal to the share in the net assets, and there is no goodwill. So the investment appears at 200 and the equity appears at 200. This is the consolidated financials of A. Then let's look at the consolidated financials of B. In the consolidated financials of B, what he has done, he has aggregated the assets of C. 100% assets of C has been aggregated. No NCI was there earlier. And the equity is reflected at 1000. They kept it very simple. So this is the balance sheet of A using equity method under Ind AS 28. This is the balance sheet of B applying Ind AS 110, a full consolidation. Then the financial statements after this transaction. Now he's giving you the financial statements after this transaction. Let's have a look at the financials of B after the transaction is done. Now, once this particular transaction is done, remember, you just need to incorporate that entry. Bank got a debit to the extent of 300. NCI got a credit to the extent of 200. And 100 was the gain, which was directly taken to equity. So I'm just incorporating this entry in the consolidated financials of B. So if you look at the previous balance sheet before, just incorporate this entry. So you can see the cash appearing at 300. This is 1. You can see the NCI appearing at 200. There is 2. and equity gets a credit of 100. You can see the credit of 100. So this becomes 1100 and the assets continue to be 100%. So all we've done, we've just incorporated that entry in the books. Now you can see one thing, that the net assets of the company, the net assets of this company is now appearing to the extent of 1100. So the question now arises that earlier A recorded 1000 into 20%. Now he should be recording 1100 into 20%. That means his share in the net assets is supposed to be 220. So earlier A was reflecting in the financials. If I go back, you can see earlier A was reflecting the investment at 200. Now it should appear at 220. So the question now arises, what is the entry which A should pass in the books? Can I say what is the increase in the net assets of B? The net assets of B increased by 100 with a corresponding credit to SOKI. So A should also give a increase in the investment with a corresponding credit to SOKI. So the entry is going to be investment debit to the extent of share in that increase of 100, that is 20, and the corresponding credit should go to equity. So you can see that's what is mentioned out here. Let's have a look at what is the requirement. So we are given in this particular case. Let's have a read. Although A did not participate in the transaction, the share in the net assets in B increased as a result of 20% sale. Effectively, A's share in the net assets is now 220, that is 20% of 1100 as compared to the previous share. How is the equity transaction recognized in the financial statements of B in the consolidated financials of A that uses an equity method to account for investment? Well, as I said, the entry is going to be directly given a credit to SOKI. So we can see in this case, it very clearly says, let me show you the answer. It says the share of other changes, and this, where does it go? Okay, it says in the given case, A recognizes 20 as changes in other equity instead of statement of P&L and maintains the same classification as of the associate. And that is important. He maintains the same classification as of the associate company. So the moral of the story is that if the associate company equity goes up, you need to see where did the credit go. So if the credit went to P&L, investment to P&L. If the credit goes to OCI, investment to OCI. If the credit is to equity, entry investment to equity. So the investor is supposed to put the entry investment debit to the extent of share in the increase in the net assets with a corresponding credit to P&L, OCI, or equity, whatever the case might be. That is the essence in terms of equity method of accounting. Right, friends, so far so good. I guess you all been able to get the understanding on this. And Kaushik, you said, so goodwill will always remain the same as recognized on the date of acquisition? Yes, because it's not a part of the outer column. So whatever goodwill identified, that continues to be the same. Yes, of course, unless there is impairment of investment, in which case changes could come in. Okay, so this is one area. The third section is done. I've given you assessment of significant influence, scope of the standard with the exception. I've given you the equity method application, how the movements are to be recorded in a one-line consolidation. Now we are going to come to a very interesting case, and that is the appendix of the Ind AS 28, where there is a very interesting illustration given in the study mat based on the guidance which is given in the appendix of Ind AS 28. Now, let me start explaining that. That's a little ticklish kind of a question. I'll go a little slow on that illustration, but you'll definitely understand that. Let me just go to the illustration and explain certain concepts to you. So I am looking at the page number 14.161. First, let's give you a basic concept, and then we'll take the journey forward. So let's have a look at a basic concept, and then we'll move forward. Technically speaking, if you ask me how many types of questions can come under Ind AS 28, I would say there are four types of questions. If you technically ask me, I would say there are basically four types of questions which can come in terms of the examination. One is, you can say a profit-making associate. You can say a profit-making associate with the investor having no long-term interest other than equity. Mind the language carefully. So one of the plain vanilla question is that as an investor, you've got only equity investment and the associate is a profit-making company. Number two, there could be a case where the associate company is a loss-making company and you've got no other investment other than equity. So two plain vanilla cases are there that you can say that as an investor, I don't have anything except equity investments. It's either case one, a profit-making associate, or a case two, that there is a loss-making associate. Then I would say there could be a third question, and that is, you have got interest other than equity investments. In the associate company, you've got certain long-term interest other than equity investment, but the associate is a profit-making company. And the fourth combination is that you've got other than equity investments and the associate is a loss-making company. Now, let me tell you, the appendix of Ind AS 28 triggers only when two conditions are met. The appendix which I'm discussing with you gets triggered when two conditions are met. Number one, as an investor, you've got other than equity investments, one. Number two, the associate should be a loss-making company. Because if the associate is a profit-making company, then this concept would not apply. Then it's an ordinary question as good as where you had no other long-term interest. So remember one important thing, that for the appendix A to get triggered, for the appendix, I think it is appendix A, I'll not put the number. For the appendix of Ind AS 28 to trigger, there are two conditions which you need to meet. Condition number one. So there are two conditions which I need to meet. The condition number one is that you've got long-term interest apart from equity investment. So that is condition one. As an investor, you've got other long-term interest in terms of maybe preference shares or certain long-term loans other than equity investments. That is one. And there is a condition number two. And the condition number two is that the investor, the associate, is a loss-making company. The associate is a loss-making company. So if you're able to fulfill both the parameters, trust me, the appendix will get triggered. If your associate is a profit-making company, then this appendix cannot trigger. And you'll see the role why. Now, the only question what comes to the mind is, what do you mean by a long-term interest? Now, I guess you might recall what you've done in terms of Ind AS 21. In terms of Ind AS 21, if you recall, there were cases where we said that there could be investment, which is called something like a permanent investment. We used to call it as a net investment. NIFO, it's a net investment in a foreign operation. If you remember, it was like a permanent investment where you put some money into a subsidiary company. You've neither got any intentions to get that money back. You've given a loan to the subsidiary company and you've got no intentions to take the money back. Neither it has been planned that you're going to ask for that money. So there is no pre-decided dates when you go to ask that money back, and it's neither planned nor there is any intention. So as an investor, I put in some money into my subsidiary company, which is not an equity investment. It is given as a loan, but there is no intentions to take the money back. There is no pre-decided date when you're going to take the money back. So no planned, no intentions, nothing is planned to take the money back. It is considered as good as a permanent funding in those companies. The same case can happen in terms of associate as well. The investor might put in money into the associate company other than equity investments where the intention is not there to take the money back. So these investments are as good as permanent funding. So we're talking of the long-term interest, and these long-term interest would be in terms of those investments where there is neither any intention nor you're planned. And typically, I would say there will be two kinds of investment. Typically, I would say there will be two kinds of investment in this particular case. One is, you can say, preference shares, and one is, we can say, long-term receivables alone. We're not covering short-term loans. We're not considering trade receivable. The intention has to be very clear that you make investment in preference shares or long-term receivables or loans of the associate company where there is no intention to take the money back. You give them the money and there is no intention to take the money back. So it is as good as a permanent investment. So Ind AS 28 appendix gives you a guidance that if the associate company is earning a loss, then apart from booking that loss against equity investments, I'll start booking that loss against these long-term investments as well. Why should the equity investments get depleted because the associate is earning loss? Your long-term investment should also get a hit. Now, how does that hit happen? Let's, I think, explain that with a simple example. There is an illustration number 15, page number 14.163. Let me just read this to you. Now, watch this carefully. I'll go a little slow on this illustration. It's pretty simple and pretty straight indeed. Just watch this carefully. Go through the steps carefully. Can you notice it says loss-making associate and long-term interest? As I said, the appendix to Ind AS 28 is going to trigger only when two conditions are met. You've got an associate, which is a loss-making company, and you've got long-term investments other than equity. Otherwise, appendix cannot trigger. Entity A has got following three types of interest in the associate. You've got equity shares, 25%, to which equity method of accounting is applied. You've got preference shares, which is non-cumulative, and it forms part of the net investment in the associate. It's like a permanent funding. And they're measured at a fair value as per Ind AS 109. There is a long-term loan with a 10% interest, and the interest is received every year. But the long-term loan is accounted at amortized cost as per 109, and this also forms part of the net investment. So when I say it is a part of the net investment in the associate, it indicates it's a permanent funding. The investor has got no intentions to get the money back. He's putting this money into the associate company, has got no intentions to get this money back. It's as good as a permanent funding. It's as good as equity investment. So there is, you can say, other long-term interest apart from the equity investment. Then he says at the start of the year one, the carrying value of these investments are given, equity, preference, long-term acquired, the cost is given to us. The following table summarizes the changes in the fair value of preference shares as per 109, impairment losses on long-term loan. The preference share, which is measured at a fair value, we need to capture the fair value increase or decrease every year. The long-term loan, which is taken at amortized cost, you will not capture the fair value, but impairment testing would be done. And if there is impairment loss, that will be recorded. So he's given you the fair value changes in terms of preference shares, and he's given you the impairment losses in terms of the long-term loans. So let's have a look at the fair value changes on preference, and let's have a look in terms of the impairment losses on long-term loans. So this is the fair value changes on preference share. This is the impairment and the reversal of impairment on the long-term loan year by year. And this is the share in the losses and the profits. So we can see that initial 2 years, they've got a loss. Throughout year 1 to 3, there has been no objective evidence of impairment in net investment. The entity does not have a legal or constructive obligation to share losses beyond its interest in the associate. We are responsible to share a loss only to the extent of 16 and 2 lakhs. Based on the above, determine the closing balance of each of the above interest at the end of each year. We need to now calculate the value of these 3 investments in the consolidated balance sheet of the investor. Mind you, I'm now going to work on a total of 5 years with you. We need to see that what is the value at which investment will appear at the end of each year. Now watch this carefully. You'll get the concept easily. Let's watch this carefully. Let's go year by year. So we're going to consider 5 years. Let's go year by year. Watch this carefully. It's pretty easy. See my steps very carefully. Step number 1. You will first of all account for the preference and the loan based on Ind AS 109. Step number one. I'm going to first of all apply Ind AS 109. I'm going to first of all apply Ind AS 109 to long-term interest. I'm not talking of equity investments. I'm talking of preference and loans. So we're going to apply Ind AS 109. The preference share fair value changed by 50,000. The long-term loan got impaired by 50,000. So what we have done, we have recorded the fair value decline as per 109. So the value stands at 450. We've taken the impairment loss and the value stands at 250. Step number one, apply Ind AS 109. Consider the fair value changes, consider the impairments, whatever, get the revised values. This is step one. Now, step number two. Now we go to the step number two in this case. Now, you know that in year one, if you keep the question in front of you, the associate companies, the share in the associate company losses 16 lakhs. You've got a share of 16 lakhs in the first year. Now, investment in the equity is appearing at 10 lakh. How can you reduce it by 16? At the maximum, the investment can decrease by the book value, which is 10 lakh rupee. You cannot reduce the investment by 16 lakhs. Now, let me tell you, if it was a case where no other long-term interest was held, I'm coming to a case, if it was a case where no other long-term interest is held, I would reduce the equity investment by 10 lakh and I will give a notes to accounts that 6 lakh is the carried forward loss. I'll give a note in the notes to account that 6 lakh share in losses cannot be accounted for. It will be carried forward in the notes. Next year, if the associate company earns a profit, you will not show the investment in the balance sheet until you earn 6 lakh share in profits. Get it very clear. In the first year, you reduce the investment by 10 lakh rupee, 6 lakh not adjusted is carried forward in the notes. The investment will not appear in the subsequent year's balance sheet till you get a share in the earnings equal to 6 lakh. Only after the share in 6 lakh is earned, the investment will reappear in the console. But in this case, you've got other long-term interest. So now what does the standard say? It will be inappropriate to show this investment at 450 and 250, considering that your equity investment is going to be shown at zero. Then why should the other investment, which is as good as equity, continue to be shown as per 109? So what are we going to do? Out of the 16 lakh, first you allocate the loss to equity. Now you need to understand that if a company liquidates, what is the order in which the money is paid? If the company liquidates, what is the order in which money is paid? You go to first pay the loan holders, then the preference, and then the equity. So when you're going to pay them on liquidation, the loan people get the money first, the preference gets the money thereafter, and the equity gets the money at the end. So if you were to distribute money, he will get preference 1, preference 2, and preference 3. This is the order in which they will stand in the queue. So the losses should be given first to equity, then it should be given to preference, then it should be given to loan. Reverse order in which payments are made. Payments are made in the order 1, 2, 3. So losses will be paid in the order 1, 2, 3. First, you give the loss to equity, then to the preference, and then to the loan. So 10 lakhs is given to the equity, then you need to give the loss to the preference. So in this particular case, maximum to the extent of book value 450, the rest remaining 150 is given to the loan. So out of 16 lakh, 10 lakh goes to equity, leftover is 6 lakh. 450 goes to the preference, leftover is 150. He bears the remaining 150. So the new value of the investment is 0, 0, and 1 lakh. Got the step number 1 and 2. First, apply 109. Get the fair value changes and impairment losses first, then see the share in losses. The losses will first go to equity, then to the preference, and then to the loan holders. And you get the values for the purpose of consolidate balance sheet. I hope, friends, year one is pretty much clear, I guess, right? Now let's go to the second year. Let's go to the year number two. So this was year one. Let's go to the year number two now. Now, in terms of the year number two, we're going to take the closing balances of year one as the opening balances of year two. So we're going to consider the opening balances of the closing balance of year one as the opening balance. So we can see these are the balances taken from the previous year. So here again, step number one, Ind AS 109, fair value changes, impairment losses or reversal, whatever. So this is step number one again. So what do we do in step number one? We consider fair value decline and there is no impairment in this case. But the problem is the value of the investment is 0 and the fair value decline is 50. You have to book this 50 because that is a fair value decline as per 109. So now what you'll have to do, I will say, since because of Ind AS 28, you allocated losses, now it is standing 0, but I need to book this 50. So 50 losses given earlier reversed. You gave them a loss of 4,50,000, but now you realize that we should have given them a loss of only 4 lakh. So 50,000 excess loss is going to be reversed. So we will reverse the losses which was booked to them earlier. In year one, I gave them a loss of 4,50,000 due to which the investment became 0. So now what I need to do, I now need to book this loss of 50. So you need to reverse a loss of 50, which was given to them. So we're going to reverse that 50 so that the investment becomes 0. So that you can reduce the loss of 50. So 50 losses which was given to him earlier will be reversed so that the fair value changes can be recorded in this case. Okay, next. In long-term loan, there is no change. Now, the total losses which is given to me, if you look at the total losses in the second year, I guess the total losses in the year number 2 is 2 lakhs. The losses is 2 lakh, but he can be given a loss of only 1 lakh rupee. So he will be given a loss to the extent of the book value, which is 1 lakh. Now what is happening? He is given a share of 1 lakh loss. He is given a reversal of 50. So the total loss allocated is only 50. Mind it. The share in the loss total is 2 lakh rupees, but I'm not able to allocate the entire 2 lakh rupees because equity cannot bear anything. That's already in 0. As far as the preference share is concerned, you gave them an excess loss. In order to allocate that Ind AS 109 fair value change, you need to reverse 50, which was booked earlier. So you're reversing a loss booked earlier, 50. You're giving him a loss of 1 lakh rupee, so the net loss allocated is 50. So out of 2 lakh rupees, only 50,000 got allocated. Rest 150 carried forward in the notes to accounts to be adjusted in the next year. So in this particular case, we can say 1.5 lakh losses is carried forward to be adjusted in the next year. Because you could allocate 1 lakh and you had to reverse 50. So out of a total loss of 2 lakh rupees, only an amount of 50,000 got allocated, rest 150 losses not allocated, carried forward. All these investments stand at 0. Let's go to the year 3 now. Let's go to the year number 3 now in this case. And let's look at year 3 and then year 4. So let's have a look at year number 3 and the year number 4. This is the opening balances. Closing of the previous year becomes the opening of the next year. Now, in this particular case, we go for step 1, 109. Fair value increase. Reversal of impairment loss. Now, there is a first and second year, there was a decrease in fair value and impairment loss. Now, there is increase in fair value, reversal of loss. The investment is standing at 150 based on step 1, 109. There are no losses now in third year, but there is 1,50,000 carried forward from the second year. No losses in third year, but there is 150 carried forward from the second year. 150 losses carried forward from the previous year is now to be allocated. Give him 1 lakh rupee. to the extent of book value, give him 50,000 to the extent of book value. The previous carried forward losses adjusted. Now a permutation will come to your mind. Sir, if this was 80, then give him 80. And this is 50, give him 50. So 130 gets allocated, remaining 20 carried forward for the next year. Simple and straight. You need to see that in this particular case, the losses of 150 is there. You allocate 1 lakh to the extent of book value. You allocate 50. So entire carried forward losses gets adjusted. So the value of investment now stands at 0 at the end of the third year. Then we go to the next year. So this closing becomes the opening next year. Again, step number 109, fair value increase and no impairment or reversals. So this is the investment value as per 109. In the fourth year, there are no losses. There are no carry forward losses. There is only profits earned. Now crucial. Fourth year, the associate companies, the investor share in the associate company profit is 10 lakh rupee. Now, this 10 lakh profit will be divided first when the losses were allocated, allocation equity, preference, loan. Distribution of profits, loan, preference, equity. First out of this 10 lakh, the loan holder gets money, then preference gets a money, and then equity gets a money. So when the losses will come, you will kill the equity first, you'll kill the preference, you kill the loan. When the money is to be paid, you pay the loan, you pay the preference, and then pay the equity. But to what extent? जितना losses आपने उनको दिया था, उतना वापस करो. Go back to the previous years and see what was the losses given to the loan. If you go to the year 1, 2, 3, if you go to the year 1, 2, 3, I guess in terms of year number 1, the losses given to the loan was 150. Second year, the losses given was another 1 lakh. So you've given them a total of 150 plus 1 lakh, 250. Third year, you gave him 50. So third year, if you gave him 50, the total losses in year 1 plus year 2 plus year 3 is given to the extent of 3 lakh. So first give him 3 lakhs. Go back to the year number 1, year number 2, year 3, see how much losses was given to the loan holders in year 1, 2, 3. So you gave them 3 lakhs. So first give him 3 lakhs back. Then let's go to the preference and see what is the losses you've given to these people in terms of preference. Preference, you gave a loss of 4 lakh 50. Then preference, you gave a reversal of 50. So 450 minus 50, losses given 4 lakh. The losses given 4 lakh, and you gave a loss of 1 lakh. So total losses given so far is 5 lakh. 450 in the first year, 50 reversed in the second year, plus another 1 lakh in the third year. You've given him a losses of 5 lakh, give him 5 lakhs, and the balancing figure goes to equity. The balancing figure 2 lakh goes to equity. Now whatever will come will go only to equity. So this is now the revised value of the investments after the allocation of the profits in the associate. So finally, as far as year number 5 is concerned, now the job is simple. In year 5, the associate companies, the investor share in the associate company profit is 10 lakh. You've already given. Now first what do you do? Step 1, Ind AS 109, fair value change, no impairment. You get the values as per 109. Now there is a profit of 10 lakh rupees, and this 10 lakh rupees entirely goes to equity because losses which were allocated to loan and preference fully reallocated. So now the entire profit goes to the equity and you get the new carrying values of the investment. Isn't that pretty interesting? So you can see that this appendix is telling us that if you've got investments other than equity, so if you've got investments other than equity and the associate is in a loss-making company, you would allocate the losses to the equity, then you should allocate the loss to those long-term investment as well, which is a permanent funding as good as equity investments. Why should they appear in the books of accounts as per, fair value, that is Ind AS 109? You should bring down those investments in the consolidated balance sheet as well. Let them also take a hit. because the equity investment is getting depleted. The so-called long-term investment, which is as good as a permanent funding, should also be reflected at a zero value. They should also bear a loss. So this is a treatment applicable only to the consolidated balance sheet. That was appendix of Ind AS 28, friends, to you. Okay, I guess, friends, I hope I've made myself very clear. So we've covered the fourth section as well. So I would have done some more questions and all, but I think with the time available, I think we've tried to get the maximum out of it. And I've covered all the four sections with you. I've covered the assessment of significant influence. I've covered the scope of the standard where you get exemptions under equity method. I've covered the aspect of equity method accounting with you. I've also given you the appendix information when there are long-term interest other than equity investments. What happens? Right, friends. So I think over to you for any questions coming at your side, friends. So far, I think I am done with the standard. Any questions coming to your mind, please ask me. So if you've got no questions, then I think we are done for the day. So the consolidation standards trail is over. Now what you need to do, you need to revise the entire chain. I'm sure you would have done that earlier as well. Now the entire standards in terms of 103, 110, 111, as well as 28 and a bit of 27, everything is done. And these standards could at times get a weightage minimum 16, 20 marks, but it could extend to almost like 30 marks in the exam. Because if you're lucky, you might get a question on Ind AS 103 as well as on Ind AS 110, but at least generally, invariably, you see at least one of them. Last time, as I said in the examination, the question on Ind AS 110 was not there. So maybe on a logical levels, we maybe feel that we might get a question on 110 this time. Right, friends, so I think it's time to bid goodbye to you. So thank you very much. And if you've got any queries, please mail it to the ICI email which you have for your queries. I'll be more than happy to share your queries. It was a wonderful journey of consolidation standards with you. So thank you, all of you. Bye-bye and take care.